maintaining your current Australian property or properties while moving abroad, or considering purchasing investment properties in Australia, this video is for you. In this video, I break down the tax considerations relating to income tax, capital gains tax, and some ways to mitigate those taxes. If you have any questions about Australian property and taxes on Australian property, especially as a non-resident, please comment below or reach out. Income tax with your properties. One thing you need to be wary as a non-resident for tax purposes in Australia is you are taxed at 32.5% from the first dollar. That means if your property in Australia is positively geared, you are paying 32.5% of every dollar above that to the ATO. And there are ways to potentially mitigate this that we'll go through down the track. Capital gains tax for properties in Australia. With taxable Australian property, you are still under the obligation, as per every other Australian tax resident, to declare that capital gain on your disposal of that asset. So notwithstanding your tax residency status, there is still the obligation to declare this and potentially pay tax on it. And as I mentioned before, the tax rates differ, so you may be paying a bit more tax as a non-resident than a resident. Other tax considerations here for non-residents holding property in Australia is one, you are no longer able to access the main residence exemption, and this may affect you significantly. Another aspect for being a non-resident is you're unable to access the 50% capital gains tax discount that's available for Australian tax residents. The unfortunate part here is I have seen some ill-timed sales of Australian property that have resulted in large tax debts for my clients. And if they just consulted with me a little earlier and we came up with a strategy relating to this, they may have saved themselves significant amounts of taxes. One manner to mitigate the loss of the main residence exemption is to continue to utilize the 6-year rule, which is still available to you as a non-resident. What the 6-year rule actually says is that you may be able to rent your property out for up to 6 years and still be able to access the main residence exemption if you don't have another property as your main residence. One strategy that I've seen some clients do is that they may be abroad for, say, 5 years, being genuine non-residents, need to come back to Australia for a year to manage some finances or manage some other personal aspects. And what they've done is they've moved back in the property. And then after that, they reset the 6-year rule, meaning that they've got another 6 years where they may be able to access main residence exemption. Another manner to manage your Australian tax debt is by using genuine deductions as you would use as a normal Australian tax resident. And so these may vary from bank interest to insurance, to body corporate fees, to utilities and council rates, or depreciation costs, or even pest control or gardening. Another strategy that I've utilized for my clients to reduce their tax debt on their rental properties is by contributing money to superannuation. And obviously, this relates to your personal circumstances. So depending on where you're at, it may not be applicable or may not be right. But one aspect here that we need to consider is instead of you paying 32.5% in your personal name, you can potentially only pay 15% tax when you contribute to super. And then with that contribution, you can then claim it as a tax deduction in your personal name, thus reducing your income tax in your personal name to effectively zero. If you want to learn more about Australian taxes and how they relate to your property, please do not hesitate to reach out. And if you want to learn more about Australian tax residency and the importance of it, please watch this video here. Thank you.